Joining us this hour, we've got my co-anchor, Julie Hyman, and of course, Brian Chung and Julia LaRoche. But we want to talk about this crash in oil prices and to help us understand what is going on. Scott Bauer from Prosper Trading Academy, he's the CEO, is joining us. And this is more than just we don't have any place to store it. This is demand destruction, right?
It is complete demand destruction. However, because of the imminent nature of the current oil future contract expiring tomorrow, that is exacerbating the situation. So what's going on when we see, oil trading right here at $11, right? That is because the May contract, the May futures contract expires tomorrow. Normally, traders would be able to either roll their position out to the next contract, the June contract, or decide to take delivery. Well, nobody wants to take delivery of oil right now because there's nowhere to put it. The storage capacities, especially at Cushing, are upwards of 70%. The storage out in the water is almost full. So what's happening is we've got this enormous spread between the May future that's expiring tomorrow and the June future. Again, it's all supply and demand, not just in the physical market, but in this futures market as well. And right now, there is a massive supply of the May futures contracts and very little demand for people to buy it.
Hey, Scott, it's Julie here. It's good to see you. Oil doesn't go bad, right? I mean, so you could store it indefinitely and wait for the price to go up, I suppose. But I guess as there are fewer places to store it, is the cost of storage also going to start to go up, and that then affects the whole dynamic?
Oh, there's no question about it, Julie, because we're almost at capacity. And in fact, I think you mentioned earlier and Adam mentioned, we're seeing this price destruction, the lowest it's been since 1986. And much of that, yes, is on demand, right? There is no demand, but there's nowhere to put this. So as you just mentioned, as we have to find places to literally store oil, that is going to increase the cost. And yes, it doesn't go bad. I mean, if we could store it in our backyards, we would probably do it and wait for oil to revert back up to $30, $40 a barrel and all be real happy about that. But that's not happening. And that's not what is going on in the U.S. patch here. It's just complete utter chaos between the demand destruction and nowhere to put the existing supply that we have.
So, Scott, I am curious. The world needed 100 million barrels of oil before the COVID-19 crisis. Does anyone have an accurate prediction as to how much we're going to need coming out of this crisis and how much we've pulled off the table, essentially?
So we've pulled, the easy part of that is talking about what we've pulled off, and that's about 30% at this point. So we're down to about 70 a day. Now, where are we going from there? It's anyone's guess. And I have not seen any analysis that can really pinpoint this, Adam, because so much of this depends on, are we getting back to normalcy in a month, 6 months, 18 months? And when we get back to normal, what is that new normal going to be like? Are people still going to be working remotely and not, getting in their cars and using that amount of oil that we use on a daily basis? So, any analysis that we see right now, any prediction we're seeing right now probably is almost irrelevant, to be quite honest with you.
Hey, Scott, it's Brian Chung here. So when we saw crude oil around $25 a barrel, there was all these talks about whether or not the companies which were operating at a below break-even price point would be able to survive this thing. Now, with these prices that we're seeing today, what's the concern that this is going to provide pressure for a really capex-intensive industry where you have a lot of other producers that might not be able to survive this and ultimately might default?
No doubt about it. And remember, once we get past this futures roll, which it's called, when the May futures go away and the June contract is the one that solely trades, we're going to see oil trading back to 2022, wherever the June contract is right now. But that being said, we are probably going to start seeing a lot of consolidation in the space here, and a lot of companies, either filing for bankruptcy or just getting taken out in the space because they absolutely cannot exist at these levels, and CapEx is going to zero.
Hey, Scott, Julia LaRoche here. You're just talking about the rollover that we're going through right now, and that prices would presumably go back up. I guess my question for you is, just thinking beyond what's happening within the oil markets, how does this translate even to the broader market, the equity markets? Anything that we should be paying attention to there?
Well, outside of just the energy space, the consumer would like lower oil prices in general. However, we were talking about this off air. If you go to the gas pump and you see gas traded, for $1.20 a gallon, $1.30 a gallon, whatever it is, what does it really matter at this point? Because people aren't using it, right? I've traveled, probably 100 miles in the last 4 or 5 weeks. So in the broader market, this is not really a good thing. People have talked about how this could be looked at as a tax rebate or a stimulus because the price of gas is so cheap, but it's not really happening because people aren't using it. So this is just not good for the broader market at all when people want to look at it and say, all right, well, I'm able to save my $30, $40 a week, and use it elsewhere. That's just not happening.
All right, Scott Bauer is the CEO of Prosper Trading Academy. We really appreciate your being with us here on Yahoo Finance as we try to figure out where we all go forward with COVID-19.